over $3 trillion in U.S. Treasuries. That's trillions of dollars tied directly to the American economy. At first glance, it sounds like China could simply sell all these bonds and trigger a financial meltdown, but the reality is far more complicated and far more strategic. Imagine the headlines: U.S. economy in crisis, China dumps trillions in debt. It sounds dramatic, but would it actually happen? Could America really collapse because a foreign country decides not to buy or start selling? Today, we're diving into the hidden mechanics of U.S. debt, why China's position gives it enormous influence, and why simply selling isn't the answer. We'll explore what really happens when foreign governments hold the world's largest economy hostage through debt leverage, and why this isn't about aggression, it's about financial strategy. By the end of this video, you'll understand why debt is the modern weapon that moves trillions of dollars silently across the globe.
This is one of the wealthiest and most powerful nations on Earth, but it spends more than it earns. Every year, the federal government runs a deficit, meaning it has to borrow money to cover the gap between revenue and spending. And the way the U.S. borrows is through Treasury securities, including bills, notes, and bonds. Treasury bonds are effectively government IOUs. When someone buys a Treasury bond, they are lending money to the U.S. government. In exchange, the bondholder earns interest over a specified period. These bonds are considered extremely safe because the U.S. government has never defaulted on its debt. Among the largest holders of U.S. debt are foreign governments, including Japan, the United Kingdom, and most notably, China. China's holdings are estimated at over $3 trillion, making it one of the single largest foreign creditors of the United States. But why does China buy U.S. debt? For one, it's a safe and stable investment. With such enormous reserves from its massive export-driven economy, China needs to store money somewhere that won't lose value quickly. U.S. Treasuries are considered one of the safest options globally. At the same time, holding so much U.S. debt gives China a form of financial leverage. It's a silent power. China can influence markets, interest rates, and borrowing costs without firing a single shot. But this leverage has limitations. Selling all at once isn't just impractical, it could be disastrous for China itself. Let's break that down. Imagine China suddenly decides to sell trillions of dollars in bonds. First, the market would panic. Bond prices would collapse, causing interest rates to spike. A sudden increase in interest rates would make it more expensive for the U.S. government to borrow money. Corporate loans, mortgages, and consumer loans would all rise in cost. But here's the key: China would hurt itself massively. Selling that much debt in a short period would mean accepting rock-bottom prices. Trillions of dollars could be lost in value practically overnight. On top of that, a sudden sell-off would strengthen the Chinese yuan. While a stronger currency might sound good, it actually harms China's economy because exports become more expensive and less competitive abroad. And it's not just China or the U.S. that would suffer. Global markets are deeply interconnected. A collapse in U.S. bond prices would ripple across stock markets, currencies, and economies worldwide. Countries that rely on dollar stability for trade or reserves would also experience shocks. That's why China doesn't just sell bonds on a whim. The interdependency between the U.S. and China prevents reckless actions. The system works because both sides have a vested interest in stability. The U.S. relies on foreign buyers to fund its debt, and China relies on treasuries as a safe, stable asset for its reserves. Even if China doesn't sell, it can influence the U.S. economy simply by adjusting its buying behavior. Slowing down purchases can nudge interest rates higher, increase borrowing costs, and create market uncertainty. In fact, the mere hint that China might change its buying habits is often enough to create pressure in financial markets. So, while headlines might scream about a potential U.S. debt crisis, the reality is more subtle. China's financial weapon isn't destruction, it's leverage. It's the ability to influence the system without causing a catastrophe that would hurt everyone, including itself.
This is the hidden power of debt. It's silent, strategic, and enormously influential. And understanding this interdependency is key to grasping the modern economic battlefield, where trillions of dollars move invisibly across the globe every day. Now that we understand the mechanics of U.S. debt and China's holdings, let's explore what happens if foreign buying slows or if there's even the threat of selling. Even without selling, a slowdown in China's purchases can push U.S. interest rates higher. Why? Because the government has fewer guaranteed buyers for its bonds. To attract more investors, it must offer higher yields. Higher interest rates aren't just numbers, they directly affect the cost of borrowing for corporations, consumers, and the government itself. Mortgages, car loans, and business loans all become more expensive. The stock market reacts too. Investors anticipate slower economic growth when borrowing costs rise. Even a gradual slowdown in foreign demand can ripple through the economy. The Fed often steps in to stabilize markets. They can buy bonds themselves, lowering yields and providing liquidity. But intervention isn't a perfect solution. The Fed must balance interest rates, inflation, and market stability carefully. Too much intervention could trigger inflation concerns or weaken the dollar. Global ripple effects are inevitable. Markets are tightly linked. If foreign buyers slow their purchases, investors worldwide may adjust portfolios, leading to stock market fluctuations, currency swings, and potential stress in economies reliant on U.S. dollar stability. Even countries with seemingly isolated markets can feel the shock. Let's consider two scenarios. In the first, China gradually slows its bond purchases. Interest rates rise slowly, markets adapt, and borrowing costs climb. The shock is manageable, but the pressure is real. In the second scenario, foreign buying drops suddenly, yields spike sharply, stock markets wobble, and the Fed must intervene aggressively. Panic spreads globally, though a full-blown crisis is unlikely unless multiple shocks coincide. This illustrates the true power of debt as leverage. China doesn't need to sell outright to exert influence. Simply controlling the pace of purchases or hinting at a change can impact U.S. borrowing costs, market confidence, and even policy decisions. Debt is the invisible weapon in modern geopolitics. Unlike tanks or missiles, it moves silently, influencing economies and governments worldwide. Financial strategy, patience, and timing matter more than brute force. The ability to leverage trillions of dollars without direct confrontation is a unique form of power. Understanding this gives insight into why global leaders monitor debt markets closely. Economic influence is often more potent than military might, and in this battlefield, strategy is everything.
The idea of China crashing America sounds dramatic. The reality is more nuanced. The financial system is designed with safeguards, interdependencies, and institutions like the Fed to prevent sudden collapse. But leverage, subtlety, and strategic pressure remain potent tools, proof that debt can be one of the most effective weapons in the modern world. In conclusion, China's debt holdings are less about destruction and more about influence. Selling trillions of dollars in U.S. bonds would hurt China as much as it hurts the U.S., but simply holding or adjusting purchases provides real strategic leverage. The U.S. debt system, foreign ownership, and the Fed's interventions create a complex web of interdependence. One country's actions can ripple across the globe, affecting borrowing costs, stock markets, and economic stability. Debt is silent, invisible, and yet immensely powerful. It shapes policy, markets, and international relations. In the modern financial battlefield, strategy matters more than force, and leverage is the real weapon. So next time you hear about China's Treasury holdings, remember it's not about a crash, it's about influence. Trillions of dollars move silently every day, and those movements can shape the world in ways most people never see. Debt isn't just money, it's power. And in the 21st century, understanding that power is understanding how the world really works.